Welcome to the Fundamentals of Real Estate audio CD lecture. This system is designed to maximize your learning experience and eliminates wasted time and energy. This lecture will cover the basics of real estate and successful examination techniques. Your job will be to review the basics after listening to this audio, learn the glossary, and test yourself with the practice exams. Let's begin with Section 1, Real and Personal Property and the Laws Relating to Ownership. The Department of Real Estate's testing emphasis on this topic is 11% for salesperson, 9% brokers. The two different types of property are personal property, movable, and real property, immovable. You may be tested on another term for personal property, which is chattel real. Title to real property is passed with a deed, whereas title to personal property is passed with a bill of sale. Property refers to all the rights or interest one has in a thing owned, rather than the thing itself. These rights are referred to as a bundle of rights and include the rights of possession, enjoyment, control, and disposition. Ownership is the interest and rights, the bundle of rights that a person has in the object owned. Looking at real property, the definition of real property includes land, anything permanently attached to the land or affixed to the land, anything incidental or pertinent to the land, and that which is immovable by law. Appurtenant means ownership runs with the land. It transfers automatically without the need of a separate conveyance. Stock in a mutual water company is appurtenant, and it transfers with the property. This is the most likely example that the Department of Real Estate will use to test you on appurtenance. Land ownership also gives us right to the space above our land and also extends below our feet to the center of the earth. It is real property. Inside a condominium, one only owns the airspace. The owner also owns a percentage share of the entire project, the common area. There are two types of rights that are tested with land ownership: mineral rights and riparian rights. Riparian rights allow the landowner to use the water adjacent to his or her land. To help remember the term riparian right, associate the word riparian with rippling of the water. Also remember that water rights can be lost by condemnation or prescription. Condemnation is the act of taking personal property for public use. Appropriation of water is the taking of water flowing on public domain from its natural course. Now definition 2. Attached to the land, or improvements. An improvement is anything that is attached to the land, such as a building, a fence, or a wall, built-in appliances, shrubs. These items become real property when they are permanently incorporated or integrated to the land. The third definition of real property, incidental or appurtenant to the land. Once again, appurtenant means ownership runs with the land. The last definition of real property is immovable by law. That which by law is considered immovable is real property. Now, under California's law, trees are part of the land, therefore sold with the land. Now, unless a contract for sale is made before the land is sold. Let's move on to personal property. Personal property, any property that is movable and cannot be properly classified by those previous four definitions. Note that you may be tested that mineral, oil, and gas, when extracted, are also considered personal property. Also, you may be tested on emblements. This is planted growing crops that are cultivated annually by a tenant farmer on leased land. These crops belong to that tenant even after the expiration of the lease. Any crops harvested, sold, or mortgaged is considered personal property. The department will most likely test you on the topic of fixtures, items of personal property that are attached or incorporated into the land in such a manner that it becomes real property. Now, the courts use 5 test criteria to determine if that item is a fixture. We use the acronym MARIA to help remember those 5 test criteria. The first is method of attachment. The second, adaptability. Third is the relationship of the parties. The fourth, intention. And the fifth, agreement. Let's begin with method of attachment. If an item can be removed by simply unplugging it, it is most likely personal property. If the item is attached by cement, screws, nails, or plumbing, it will be considered by the courts real property, most likely. Also remember that cost, size, time installed are not tests to determine whether an item is real or personal property. Let's look at the test of adaptability. The adaptability of personal property refers to ordinary use in connection with the land. If property is well adapted for the land or the building, it will be seen probably as a fixture. The relationship of the parties. The relationship usually involves disputes between seller and buyer or landlord and tenant. If a fixture is not mentioned in a contract and is affixed to the property, most courts will give the seller the benefit of the doubt. Any questionable fixture should be mentioned in a purchase agreement. The intention of the person attaching personal property to the land is considered the most important test in the court of law. The final test is agreement. Any item can be deemed real or personal property if it is so stated in a contract. Now, what are trade fixtures? These are personal property used in normal course of business, such as shelving, furniture, or refrigeration. A tenant may remove their trade fixtures that they have installed, providing that the real property is left in the same condition as when the lease had first begun. Now we move on to part 2 of section 1, estates and ownership. Let's now look at freehold estates, which is real property. This can also be called a perpetual estate, an estate in fee, estate of inheritance, or fee simple absolute. You will most likely be tested on these different terms for a freehold estate. The two types of freehold estates are fee simple estates and life estates. These freehold estates are the greatest degree of ownership that one can have under the law. Freehold estates receive title. An estate in fee, or fee simple is the most interest one can hold. It is of an indefinite duration. It is freely transferable and inheritable. This is referred to once again as the estate of inheritance. A fee simple defeasible estate is an estate subject to the occurrence of a condition subsequent, whereas the estate may be terminated. Thus, a fee simple defeasible. The most common example of this is, I will give you this property upon the condition that the title will be forfeited and revert back to me if alcoholic beverages are ever consumed on this premises. This is a fee simple defeasible. Another type of estate is a life estate for an indefinite period, an ownership interest in real property that exists only for the life of any designated person or persons. Note that a person holding a life estate cannot grant more rights than he or she holds. Remember that a life estate is real property. It can be sold, but it will revert back to the grantor once the designated person has passed away. This brings us to two of the terms involved with a life estate: estate in reversion and estate in remainder. Estate in reversion, the party, the grantor, giving the life estate is said to hold an estate in reversion. The property returns or reverts back to the grantor when the life estate holder dies. An estate in remainder is if an owner granting the life estate names another person to receive title upon the death of that current life estate holder. The holder of an estate in remainder or estate in reversion has no right to use or enjoy the property until that current life estate tenant dies. Now I will talk about less than freehold estates. This is personal rights to the use of real properties for a period of time. They are more commonly referred to as leases or rental agreements. In your reading, there will be a list of terms that the Department of Real Estate may test you on. Understand that license is the permission to use a property. A license can be revoked at any time. You will also want to understand the minimum requirements of a lease. We use the acronym LAN to help us remember the 4 requirements of a lease: length of time or duration, amount of rent, names of the party, and descriptions of the property. Once again, think land. Also know that a lease for more than 1 year must be in writing and signed by the lessor, the landlord. But if the lessee, the renter, does not sign, moves in, and pays rent, that person is bound to the terms of the lease. A lease does not need to be signed by the lessee. Note the term economic rent, the amount of rent a property might be expected to yield if it were available for lease in the current market. Two more important terms involved in a lease are assignment and sublease. Assignment is the transfer of the entire lease. A sublease is a transfer of less than the entire time or space of the lease. Note that a sublease transfers possession, not ownership of real property. I will not spend any time on the topic of termination of a lease or rental agreement, but make sure that you cover this in your reading. What I want to touch on next is the special purpose leases. We have the sale leaseback, which occurs when the owner sells their property to another party and leases it back for a stated period of time. This will happen most likely when the seller is waiting for their purchase to close. This will most likely occur when a seller has a gap between the time that their property is sold and their new property is purchased. This will most likely occur when a seller does not have a new property yet available to move into. A lease purchase option exists only when a tenant leases a property with the option to purchase it at a future date. Two types of leases involved with income property is the gross lease, where the renter pays only a rental fee for the use of the property. There's the net lease, where the renter pays the property tax, insurance, and other operating costs in addition to the rental payment. The landlord benefits from a net lease because it generates a fixed income. This is a good time to help you remember who is the lessor or the lessee. Remember that OR will always stand for the originator or the giver, and the EE is the receiver. You may also be tested on the topic of a percentage lease involving retail sales property. A commercial lease in which the lessee pays or may pay a certain percentage of the gross sales to the lessor. The percentage lease payments are based upon gross income receipts. Parking lots pay the highest percentage lease. Now we move on to forms of ownership. First, we have title. Title is the evidence that one has the right to possess a parcel of real property. Vesting is placing a person's name on a deed and the description of the method by which that person will hold title. There are 6 distinct methods of holding title. First, title in severalty, tenancy in common, joint tenancy, tenancy in partnership, community property, and community property with the right of survivorship. Now let's go back to severalty. Separate ownership. The sole and separate ownership of property by one individual or by a corporation. You will hear a lot these days of people becoming incorporated. A corporation is a body of persons treated by law as a single legal person, having a personality and existence distinct from that of its shareholders. A corporation can go on forever. It does not die. A corporation gives its shareholders legal and tax benefits. Next, we have tenancy in common. This is when 2 or more people concurrently own property. This is done without survivorship rights or community property rights. Note that tenancy in common allows tenants to have unity of possession, which means they have the right to occupy the property. Tenancy in common gives all of the owners a share of the income and expenses of the property. Each individual owner may sell or transfer his or her interest separately from the others. Joint tenancy occurs when 2 or more people own a property together with the rights of survivorship. If one of the tenants' owners should die, his or her interest is then split evenly with the surviving owners. Joint tenancy can never be willed. When a joint tenancy is established, there are 4 unities involved. We use the acronym TTIP. First, we have title. All of the owners are granted title by use of the same instrument. All of the owners obtain title at the same time. All the owners share an equal interest. And the possession. All the owners have an equal right to possess the property. Now, to create a joint tenancy, there must be intention by the owners. The deed must be in writing and contain the phrase "as joint tenants" or "in joint tenancy." If it does not state that it is a joint tenancy, the joint tenancy does not exist. Tenancy in partnership refers to two or more people who are co-owners in a business. We have a general partnership. The partners share all the profits and losses. And we have a limited partnership, one consisting of one or more general partners and limited partners. The limited partner's losses are limited to the amount of his or her investment. A limited partner does not share management responsibilities. In a general partnership, if a partner should die, his or her interest passes to any heirs who then have a right in the partnership, but not in any particular property. In California, you will hear a lot about community property. This refers to all the property that is acquired by a husband and wife during their marriage, when not acquired as separate property of either spouse. California is a community property state, which means that any property acquired during a marriage is shared equally. Both the husband and wife must sign all transfer documents to convey community property. If only one spouse signs a transfer document, the injured spouse could void the sale within a 1-year period. The right to manage community property is shared by both husband and wife. Note that with community property, each can will his or her respective half to whomever they wish. If there is no will, the half belonging to the deceased would go to the surviving spouse. If willed to an heir, the heir and the remaining spouse would then be tenants in common. We will now talk about the topic of encumbrances, money and non-money. An encumbrance is a right or interest in real property other than an ownership or tenancy interest. It is a burden on the property that limits its use. The two main types of encumbrances are liens, or items that affect the physical condition or use of the property. Note that all liens are encumbrances, but not all encumbrances are liens. A lien is a money encumbrance. A lien is a document that uses a property to secure the payment of a debt or the discharge of an obligation. It is money owed for one reason or another on a property. Types of liens include trust deeds, mortgages, tax liens, special assessments, mechanics liens, judgments, attachments, and bankruptcies. Liens are either voluntary or involuntary, and they are either specific or general. Blanket encumbrances are a voluntary lien placed over more than one parcel. A release clause releases portions of the property. There are voluntary and involuntary liens. Now, a voluntary lien are money debts that an owner agrees to pay. The owner voluntarily agrees to pay for the money borrowed. A lien is created when the buyer takes out a loan to finance the purchase of real estate. Involuntary liens are money obligations that create a burden on the property by government taxes or legal action because of unpaid bills. Both involuntary liens and voluntary liens must be paid or assumed in full before the owner can sell or refinance the property. Now we have specific and general liens. A specific lien is a lien against one specific property. Property taxes assessed against real property automatically become a specific lien on only that property. General liens on all properties of the owner, not just one. Federal or state income taxes and judgment liens can become a general lien on all property owned. A trust deed is a security device. It is a voluntary lien and it is specific to one property. A trust deed is a written instrument that makes real property collateral for a loan. The evidence of debt is created by a promissory note that accompanies the trust deed. The trust deed pledges or hypothecates the property as collateral or security for the note. A mortgage is also a security device. It is voluntary and specific to a property. A mortgage is a lien and is rarely used in California, though we use the term mortgage quite often here. That secures real property for payment of a promissory note or a debt. You will also find questions about mechanics liens on your state exam, so this is a topic to definitely make sure you're clear about. A mechanics lien is involuntary and it is specific to a particular property. A mechanics lien is a lien that may be filed against a property by a person who was unpaid after furnishing labor or materials for construction work on that property. Remember, once again, mechanics liens are involuntary and they are specific to one property. Now, the form used to enforce a mechanics lien action must be recorded to be effective. And this is where they'll test you. Once again, a mechanics lien must be recorded to be effective. A mechanics lien is a lien against the property itself. The property cannot be transferred until the obligation is paid and the title becomes clear. Now, there is a preliminary notice. It's a written notice that should be given before filing a mechanics lien and within 20 days of supplying labor or services. This notice must be given either by mail or in person to the owner, the general contractor, and the lender. What determines the start time for a mechanics lien? An important determination when considering a mechanics lien is the date that the work began, also known as the scheme of improvement. Note that the mechanics lien, once recorded, have priority over all other liens. This is an exception to tax, special assessment, and trust deeds. So mechanics lien have priority over all other liens except taxes, special assessments, and trust deeds. A notice of completion should be recorded by the contractor within 10 days of completion. The work is considered complete if there is a cessation of labor 30 days after a notice of cessation is filed. All of the following may affect the filing date of the mechanics lien: notice of non-responsibility, notice of cessation, and notice of completion. Now, the filing time is limited. A mechanics lien may be filed any time after the preliminary notice and until 30 days after the completion if you are the supplier or subcontractor, 60 days after completion if you are the general contractor. If there is no notice of completion recorded for the project, all parties have 90 days after the completion to file. A completion bond required by lender to ensure that insurance company will complete the job if the contractor cannot. Now, an owner can protect themselves with a notice of non-responsibility. Once again, this must be recorded and posted. The notice of non-responsibility, posted within 10 days of discovery on the property, states that the owner is not responsible for the work being done. This action releases an owner from any liability caused by unauthorized activity and prevents suppliers from filing a mechanics lien. Now we move on to tax liens. If any government tax is not paid, it may become a lien through law or a court action upon real property. If the lien is not settled, the property can be sold to pay back taxes. Tax liens, again, are either specific or general liens. Note that property taxes and mechanics liens are specific liens, whereas income taxes and judgments from the court are general liens. Special assessments. These are local improvements paid for by the property owner in a given district. And improvements such as streets, sewers, street lighting, irrigation projects are generally paid for by the property owners who have benefited from the work. If these assessments are not paid, they become a lien against the property. Notice that new home developments will generally have special assessments. Judgments are a court decision determining the right of the parties involved and the amount of compensation. Notice that a judgment can be appealed. Judgments are involuntary and general liens. An abstract of judgment or formal filing of the judgment must be recorded for a judgment to become a lien. A judgment is a general and involuntary lien against all real property in the county in which the judgment is recorded. It is good for 10 years. An attachment is court-seized property. Attachments are liens. It is a process of the law that creates a lien. It gives the custody of the real or personal property to the courts to assure payment of a pending lawsuit in that county. An attachment creates a specific and involuntary lien on one property which is good for 3 years. You may also be tested on the term lis pendens, lawsuit pending, the recording of a notice that a lawsuit is pending concerning a particular property. This places a cloud on the title and remains on the public record until judgment is rendered or the suit is dismissed. A lis pendens may affect title to real property based on the lawsuit's outcome. An injunction is a court order to stop doing something. A sheriff's sale is a court order to sell. A sheriff's sale is the forced sale of a debtor's property to satisfy a judgment under the writ of execution. Now, a writ of execution is the court order requiring the sale of a certain property to satisfy a judgment. The writ of execution extends the lien against the real property for 1 year. Now let's talk about non-money encumbrances. These are items that affect the physical use. They include easements, building restrictions, zoning, and encroachments, which are conditions that limit the physical use of the property. First, we have easements. An easement is the right to use another's land. It is the right to enter, use, and exit another person's land for a specific purpose. Included in this definition is the right to profit from the easement, such as the right to take mineral, oil, and gas. Easements are of 2 types: easements appurtenant and easements in gross. Note that an easement is a right, not an estate. Ingress is the right to enter the land. Egress is the right to exit the land. Easement appurtenant runs with the land. The easement appurtenant becomes part of the land and cannot be transferred separately from the land. Dominant tenement, the land that obtains the benefit of an easement. The servient tenement, the land that gives the easement for the benefit of another. Easement in gross does not benefit adjoining landowners. Easement in gross is an easement created for the benefit of others who not own adjoining land. An example of this would be a utility company obtaining the right to run power lines or gas line across your land. An unlocated easement, a right granted by an owner to cross his land and not limit how or where a person would have to cross. Now let's look at the creation of an easement. Easements are created in 3 basic ways: expressed in writing, as in a deed or a contract; creation by the implication of law; easement by necessity, landlocked, an easement granted by a court if it is absolutely necessary for access. And then we have the easement by prescription, long use. Possession for 5 continuous years can create a prescription as long as there is open and notorious use, uninterrupted use for 5 years, hostile use without the permission of the owner, and under a claim of right. The transfer of an easement is done automatically if there are easements appurtenant. Easements in gross can be transferred only by the expressed agreement, provided the easement is not made to a specific individual. Looking at the termination of an easement, easements may be terminated in several ways. Express release, only the servient tenement can benefit. An easement terminates when the dominant and servient tenements merge into a common or single ownership. Excessive use may terminate an easement. Increases the burden on the servient tenement. Easements may be forfeited through a court injunction. Abandoned easements may be lost through court action. An easement gained through prescription may be extinguished if non-use exists for a period of 5 continuous years. Notice that non-use can only terminate an easement created by prescription. When a servient tenement property is taken through eminent domain, the dominant tenement easement is terminated. Now we move on to building restrictions, CC&Rs, and zoning. There are three types of private building restrictions: covenants, conditions, and restrictions. Now they are usually included in a deed at the time the property is subdivided, or may be created by written contract. Their main purpose is to keep the use of the land uniform throughout certain tracts of land. First, we have a private deed restriction. This limits the use or occupancy of the land. A typical restriction would be to limit the types of buildings on a given piece of land to single-family residences. A covenant, an agreement or promise to do or not to do certain acts. For example, a covenant not to sell alcoholic beverages on the property, or a covenant to maintain the property as a park setting. Condition. A condition is a future and uncertain event which must happen to create an obligation, or which extinguishes an existing obligation. Public restrictions are limits made by governmental agencies, usually in cities and counties, to form zoning. Public restrictions promote health, safety, morals, and general welfare of the public. This is the use of police power. Zoning is the restriction of the use of private property by local government agencies. Zoning dictates how the property can be used, the setbacks required, and the height limits on any structure. If there are two restrictions, the most restrictive of the two will take precedence. An encroachment is the wrongful and unauthorized placement of an improvement or permanent fixture on a property by a non-owner of that property. You must pursue the right to have an encroachment removed within 3 years or lose that right. Now, if your neighbor builds a driveway over your land, it is considered trespass. If a neighbor builds a wall within your property line, that would be considered encroachment. Earlier, I brought up the term police power. This is the power to make rulings to control the use and taking of private property for the protection of the public's health, safety, and welfare. The police power allows the state, county, or city to protect its citizens by controlling how land is to be used. We'll now look at basic subdivision laws. The Subdivision Map Act gives cities and counties control over the design of a subdivision. Now, the Subdivided Lands Law protects the purchasers of property in new subdivisions from fraud, misrepresentation, or deceit in the marketing of the subdivided lots, parcels, condominiums, or other undivided property interests in the state of California. The Subdivided Lands Law requirements apply when a parcel is divided into 5 or more lots. A public report is a formal disclosure report of the important facts regarding a subdivision. A public report may be obtained by anyone. A final public report, the Real Estate Commissioner's final subdivision public report, is the official report that must be given to the buyer. The buyer must sign a receipt stating that the report has been received. There is a 5-year time limit on the report, and it can be updated and renewed. Any material changes in the subdivision or its handling after the filing is made or the public report is issued must be reported to the Commissioner of Real Estate. Changes in price is not a material fact. In general, the Subdivided Lands Law applies to 5 or more units, while the Subdivision Map Act applies to 2 or more units. They both, however, cover 2 or more units where cooperative ownership apartments or condominiums are concerned. Land projects are state law. By law, any contract to buy or lease in a land project may be rescinded without cause through written notice before midnight on the 14th day after the contract is signed. A condominium is an example of a common interest development. This is a project where common areas are used by all and separate interest is for the use of individual living units. It is managed by a nonprofit association. Notice that condominiums may be used for residential, industrial, or commercial purposes. A condominium owner gets a deed, this is a fee interest, to a unit and a separate tax bill. Also note that if zoning conflicts with deed restrictions, the most restrictive controls. Owners, subdividers, and government agencies can petition for zone changes. Zoning laws do use police powers granted to every county and city to regulate the use, planning, and setbacks of the land. A variance is an exception to the existing zoning regulations in case of a special need for circumstances that might create serious hardship for the property owner. Zoning restrictions, such as setbacks, may be removed by petition or by a variance. A grandfather clause allows an owner to continue using his or her property in a way prohibited by the new zoning condition. A conditional use permit, an exception to the current zoning for public welfare and benefit. Variances, on the other hand, are based on hardships. The final topic for Section 1 will be eminent domain. This involves involuntary and voluntary conversion and condemnation. Eminent domain is the right of the government to take private property from a landowner with the fair market value paid as compensation to that owner. And this is done for the public good. Severance damage is the compensation paid to that owner. An involuntary conversion is the legal conversion of real property to personal property. Inverse condemnation is the action where the property owner files suit to force the government to take all of the property and not just part. This concludes Section 1 of the audio lecture. We will be moving on to Section 2, Tax Implications, tested by the Department of Real Estate to 8% for the salesperson and brokers, and we will start by looking at property taxes. Section 2 covers tax implication. The Department of Real Estate's testing emphasis for salesperson and brokers is 8%. Real property taxes are determined according to the value of the real property and is paid semi-annually. These taxes are called ad valorem taxes. Note that real property is assessed each time the property is transferred at 1% of its selling price or market value, whichever is higher. A keynote here is the county assessor assesses, the county tax collector collects. The County Board of Supervisors sets the tax rate. The city or county fiscal year starts July 1st and ends on June 30th. 4 months after the beginning of the fiscal year, November 1st, is the first installment's due date. On December 10th, the first installment is considered delinquent if unpaid. On January 1st, the tax will become a lien, and on February 1st, the second installment will be due. The second installment will be considered delinquent if unpaid on April 10th. To remember this, we use the phrase, "no darn foolin' around." Once again, remember that property tax becomes a specific lien. A property owner will go to the Assessment Appeal Board to file an appeal to object to a property tax assessment that was set too high. A book sale is a formality which starts a 5-year redemption period for properties which taxes have not been paid on or before June 30th. Although the property taxes are not paid, an owner can remain in possession and could redeem for a 5-year period. The county tax collector will sell the state-owned properties to other taxing agencies or to the highest bidder at a public auction. Now let's take a look at special assessment tax. The special assessments finance only off-site improvements, not the purchase of land. The Street Improvement Act of 1911 finances street and highway improvements through an assessment of property owners based upon the frontage they enjoy facing the improved street. This is also called the Bond Act of 1911. If you purchase a lot for $40,000 and assume a $1,200 assessment bond, your cost basis for income tax purpose would be $41,200. If you purchase a lot for $80,000 and assume a $2,000 assessment bond, your cost basis for income tax purposes would be $82,000. In real estate, you will also hear the term Mello-Roos liens. This is municipal bonds issued to fund streets and sewers and other infrastructure needs before housing development is built. The developer is usually responsible for making payments to the bond until the home is sold. Then the homeowner is now responsible for that payment. Here are some items that may be found on the state's exam. Tax shelters are a way to reduce income taxes. Interest, property taxes, and prepayment penalties paid on your personal residence can be deducted from your income tax. You can also deduct a loss on a sale of personal residence if you have turned it into an income-producing property by renting it. Prepaid rent money collected by landlords is taxable income when it is received. Notice that owners cannot deduct losses due to vacancies. Only the buildings and other improvements can be depreciated, not the land. In looking at depreciation for tax purposes, residential, home or apartment properties have a minimum of 27.5 years to depreciate. Commercial improvements have a minimum of 39 years to depreciate. In addition to depreciation, two major tax benefits of owning income-producing property are installment sales and 1031 tax-deferred exchanges. Installment sales are used because a gain is only taxed in the year that it is received. Spreading that gain over several years may drop you into a lower tax bracket. In an exchange, the adjusted cost basis of the old property becomes the basis of the new property. A boot is a debt relief from a loan in a 1031 tax-deferred exchange. Exchanges are popular among apartment owners and commercial property investors. This is because these owners are usually in a high income tax brackets, and exchanging enables them to move up to a more valuable property without paying taxes on that gain. Here are some advantages of a sale leaseback. The buyer gets to depreciate the new building's cost. If the owner of a business sells her building for cash and then leases it back, the seller has become a lessee and the buyer the lessor. The seller, now the renter, deducts 100% of future rents paid. The buyer can now depreciate the new cost basis of improvements. Note that a local building inspector usually enforces the state housing laws. Section 3. Property Appraisal. The Department of Real Estate's testing emphasis for salesperson and broker's exam is 15%. I'd like to tell you now that this topic is the most important for your salesperson's exam. You're going to want to cover the audio and the reading several times to make sure you really understand this topic of valuation and appraisal. With that said, let's begin. An appraisal is an opinion as to the value of a particular property at a given date, and that date only. For your exam, please remember that an appraiser is guilty of a felony if using improper appraisal techniques. You may be tested on the terms market price and market value. Market price is the total price, including the down payment and financing that a property actually brought when sold, whereas the market value is what it should have sold for in a competitive market. When looking at value, we want to look at the four essential elements of value. These are demand, utility, scarcity, and transferability. We use the acronym DUST here to remember those elements. Demand is the desire, need, and ability to purchase. The utility is the usefulness, the ability to instill a desire for possession. The scarcity, in short supply, would be usually more expensive. And transferability, whether it can change ownership, as with a deed. This ties in a bit with what we talked about earlier, where a life estate would hold less value than a fee simple estate. Another thing to note here is that the cost or price is not one of the four essential elements of value. The appraisal process is an orderly program by which the problem is defined, and then the work is planned, the data is gathered, it's analyzed, and correlated into an estimate of value. A question you might see on your exam is, what is the first step in the appraisal process? That would be defining the appraisal problem. The first objective of an appraisal is to determine the highest and best use. When preparing an appraisal report, the appraiser will be gathering data. He will be looking at general data and specific data. These are clearly outlined in your text. General data includes regional and neighborhood data. Specific data involves the property itself. The most important economic characteristics is area preference, location. We've also included in your reading some house structure terms. Make sure you know these, you may be tested on them. I'd like to touch on the topic of basic appraisal principles, and these are valid economic concepts that are applied to the appraisal of real estate. First, we have the principle of supply and demand. And that basically states that the supply of land decreases, the value of land increases, because more people are competing for that desirable land. The principle of change states that the real property is constantly changing, and the value is influenced by the changes in such things as population size, retail sales and establishments, schools, colleges, freeways, economic and social trends. Change is evidenced by the fact that neighborhoods tend to pass through 3 stages of real estate life cycle, or age cycles. We have the development stage, maturity, and old age. Principle of conformity states that the maximum value is obtained when a reasonable degree of building similarity is maintained in a neighborhood. And you definitely see this in California in new home development. If all the homes in the area are similar, not identical, the maximum value of real property is created. Now, the principle of conformity is one of the primary reasons for zoning regulations. They protect the neighborhood from other non-conforming use and from infiltration of incompatible structures. You could see why a home would lose its value if it was built between a gas station and a supermarket. We have the principle of contribution. This states that the value of a particular component is measured in terms of its contribution to the value of the whole property. An example here is an appraiser would apply the principle of contribution to determine if a swimming pool to a 30-unit apartment would be economically justified. Notice here that cost does not necessarily equal value. Now, the principle of substitution is probably the most important principle. Now, this states that the buyer will not pay more for a particular property if it costs less to buy a similar property of equal utility and desirability. Now, when appraisers use the principle of substitution, they compare properties and adjust for differences. This basic principle is used in the market data method that we'll be discussing further. The principle of regression basically states that between properties in the same neighborhood, the value of the best property is adversely affected by the value of the worst and other properties. The principle of progression is the opposite. It states that the value of the worst home in the neighborhood is increased by that home that is the nicest. The market data method is also called the comparative, the comparison, or substitution approach. The market data method simply takes the current selling price of similar properties and adjusts those prices for any differences. The market data method approach uses principles of substitution. A person will not pay more for a property if he or she can buy something similar for less. The market data approach is the oldest, quickest, most efficient, and easiest to learn, and most adaptable. The market data method is the most common approach for houses and condominiums and land. It's also the best method for appraising lots and unimproved property and obtaining rental rates. You will also use the market data method to appraise amenity property. Now, what is an amenity property? An amenity property is simply another way of describing a home. So if you come across the question, what appraisal methods do appraisers use to appraise amenity properties, you will know that it is the market data method. You do also want to know that the market data method is not very reliable in slow-moving markets. You may also be given this question: what is the unit of comparison in a market data approach for a house? This would be the entire property is the unit of comparison. Now we're going to cover the cost approach method, basically the replacement cost method. The cost approach is the process of calculating the cost of the land and the buildings as if they were new today, and then subtracting the depreciation to arrive at the current value of the property. The cost approach method would probably be used in a special use building. A church or a commercial building would probably require this approach. Now, the simple formula is the value of the land plus new cost of the building today minus depreciation equals the current market value. Costs are both direct and indirect. The direct costs are the expenditures for labor and material used in construction of the improvement. A contractor's overhead and profits are generally treated as direct costs. Indirect costs are expenditures other than materials and labor costs. Now I'm going to break down the 4 steps in the cost approach method. Step 1 is to appraise the land or the lot separately. The cost approach requires that the appraiser identifies the value separately by the use of the market data approach. The second step estimates the replacement cost. This estimates the replacement cost of the building as if it were new. There is also what's called the reproduction or replication cost. It is the cost of reproducing a structure at current prices using similar styles, materials, and method used in the original structure. The replacement cost is the cost of building a similar new structure today using the modern construction methods. Now, although there are several ways to determine the replacement cost, the simplest way is to measure the outside of the building and determine the square footage. After you've done so, you'd multiply it by the current cost of construction per square foot to get the value as if it were new. The cubic foot method is used to appraise warehouses and multi-level buildings. The third step of the cost approach method is to estimate and deduct depreciation. Depreciation is a reduction in the value of property due to any cause. Note here that depreciation is either curable, it's profitable to repair, or incurable, unprofitable to repair. Accrued depreciation has occurred, the loss in value of improvements from any cause at the date of the appraisal. There's also the straight line method, the age life. This assumes the value declines in equal amounts of depreciation each year until it reaches 0. Now, when using the age life method, an appraiser will use an age other than the actual age of the building. This is known as the effective age. The effective age determined by the condition of the building rather than the age. If a building has been well maintained, its effective age may be less than the actual age. If there has been inadequate maintenance, it may be greater. Another term is economic life, the estimated number of years of anticipated usefulness of the improvement. Note here that the economic life of an improvement is usually shorter than its estimated physical life. The term accrual for depreciation is the concept of estimating the amount of depreciation there'll be in the future. The 3 types of depreciation are physical, functional, and economic. Another term to understand is obsolescence. We have functional obsolescence and economic obsolescence. Note here that obsolescence is not wear and tear or a method of calculating depreciation, but is a term meaning a major cause of depreciation. Let's look at functional obsolescence. It's curable or incurable. Functional obsolescence is a loss of value due to outmoded style or non-usable space. Types of functional obsolescence are outdated kitchens, antique fixtures, a 4-bedroom, 1-bath home. There are really too many to list. At this point, you could see why the cost approach would be the least useful for appraising older structures with many functional deficiencies. Economic obsolescence is a social obsolescence. It's the loss of value due to factors that are external to the property itself and not really within the control of the owner, and is always incurable. Some types of economic obsolescence are oversupply of similar or competitive units, aircraft noise, adverse zoning changes in legislative acts. There's economic recession. How about departure of major industries from that area? That would definitely be an economic obsolescence. In looking around you, you could probably see many examples of economic obsolescence. Now we move on to the 4th and final step of the cost method approach, would be the value of the property. The last step is to add the depreciated value of any improvement to the value of the land. This figures the market value of the property using the cost approach. Some of the advantages of using the cost approach is that it can be used on newly constructed buildings, unique structures, and public buildings. Remember, cost equals value when improvements are new and are the highest and best use. And also remember, the disadvantage to the cost approach is that it is limited and least reliable for those older properties. Older properties are harder to appraise because depreciation is difficult to estimate. So let that settle in a little bit, and we're going to move on to capitalization approach, the income approach. The income approach is the process of changing the net income projection from a property into its market value. Another word for this process is capitalization. Now, the actual process of capitalization is simple. Divide a capitalization rate into the net income, and the answer you obtain is the value of the property. Now, determining the appropriate capitalization rate is the most difficult step in the capitalization approach. Rent-producing properties, such as apartments, warehouses, and offices, should be appraised by the income approach. The basis for the income approach is to determine the quality, quantity, and durability of the property's net income, future income. Make sure you know the three types of method used to determine the capitalization rate. They are market comparison, band of investment, and summation. Make sure you know that those are methods of calculating capitalization rates. Rent-producing properties such as apartments, warehouses, and offices should be appraised by the income approach. The basis for the income approach is to determine the quality, quantity, and durability of the property's net income. There are basically 5 steps to establishing the value using the income approach. The first step is to calculate the annual effective gross income. Now, the effective gross income is the income minus any vacancies or rental loss. Then, we have the annual gross rental income. This will be the annual rent that the owner receives when charging the going rental rates with no vacancies. This can either be called the market rent, the economic rent, or the schedule of gross income. Remember here that the rental income schedules for various units are best established by the market approach. There are 5 basic steps to establish the value using the income approach. Step 1 is to calculate the annual effective gross income. Subtract deductions from the gross rental income for vacancies and any rental losses to arrive at the effective gross income. The second step is to complete an operating expense statement. There are 7 basic operating expense categories for this type of statement, and they're listed in your text. Management fees and replacement reserves must always be included in the basic operating expenses. Never deduct mortgage payments of principal or interest from the operating expense statement. They are part of the investor's analysis, not an appraisal. The third step is to deduct the related operating expenses. To determine net income, simply deduct the related operating expenses from step 2 from the annual affected gross income, step 1. The fourth step is to divide the net income by the appropriate capitalization rate. The capitalization rate, again, is the percentage rate that an investor expects to earn on the real estate investment. Remember, the higher the cap rate, the lower the value. The lower the cap rate, the higher the value. The final step in the income approach is the easiest in this method. It is simply the result of dividing the net income by the capitalization rate. This gives us the market value. Now, to clarify here the capitalization rate, this is the percentage rate that an investor expects to earn on real estate investment. Now let's look at gross income multiplier. It's a multiplication rule of thumb used to convert rental value into market value. Now, if we use a gross income multiplier of 15 times the yearly rent of $10,000, the property is worth approximately $150,000. A quick way to convert gross income into the approximate value is to use the gross income multiplier. Now, to determine an appropriate gross multiplier, divide the selling price of a similar property by its yearly income. So let's look at some of the advantages of the income approach. No other method focuses solely on determining the present value of the future income stream from the subject property. Now, if the purpose of the property is to generate income, you would want to use the income approach. The present worth of future benefits is what the income approach is all about. It is the most often used for multifamily residential income property, but it could also be used for any type of property that generates income. The one major disadvantage of the income approach is that it may be difficult to determine the proper capitalization rate. Now, the last and most important part of the appraisal process is correlation. sometimes referred to as reconciliation. Correlation is the process of selecting the most appropriate approach for the particular appraisal job, and then giving it the most consideration in pinpointing its final value. Now, although all three methods are used in appraisal, one is usually most appropriate for the specific appraisal problem. Now, when all this is done, we come up with the appraisal report. This is the documentation of the appraiser's finding, and it can be a prepared fill-in form. Now, there are two major types of written appraisal reports. The short form, this is a form with checks and explanations, and the narrative report. The narrative report is thought of as the most comprehensive and complete appraisal report. The standards permit an appraiser to appraise a property in which he or she has an interest as long as the fact is disclosed to the lender in writing. Now, it would be unusual for this to be accepted by the lender or client. And finally, on the topic of appraisals, remember that appraisers and real estate agents are concerned with the marketability of real property. And a fee appraiser is an independent, self-employed appraiser. That person appraises for a fee or a charge. Remember, in California, a license or certification is required to appraise real estate as a profession. Okay, with the topic of appraisal completed, take a moment to absorb the information, stretch your arms and legs, and we'll be moving into Section 4, Financing. Congratulations, you've made it to Section 4. In this section, we'll be discussing real estate financing. The Department of Real Estate's testing emphasis for salesperson and broker's exam is 17%, though currently they are testing on this topic as well as on real estate appraisal more heavily. Make sure you have a clear understanding of real estate appraisal and real estate finance before you walk in to take that exam. The first term I'd like to discuss is leverage. Well, this is the practice of purchasing real estate using a small amount of your money and borrowing a larger portion of the funds to acquire a piece of property. The more money borrowed to buy a property, the greater the leverage. To utilize the principle of leverage, an investor would use the maximum amount of borrowed money. Nowhere else can you use such a small amount of your own money to acquire such a large investment. A term that you will most likely be tested on is hypothecate. This is to pledge something as a security for a loan without the necessity of giving up the possession. Most real estate property buyers hypothecate their property as security for a real estate loan. In this case, the owner does not surrender the use or possession of the property. Let's begin discussing the promissory note. Now, this is a basic instrument used to evidence the obligation or debt. Now, it's an unconditional promise in writing by one person to another. This is a promise to pay on demand or over a fixed period of time. Remember here that in a real estate loan, two documents are created: the promissory note and the trust deed or mortgage. And this is used with the promissory note to hypothecate the property as security for the note. The terms of a promissory note can be established in several different ways. First, you have a straight note. This is the interest only. This is a promissory note which a borrower repays the principal in one lump sum at the maturity, while the interest is paid in installments or at maturity. This is a good point to define principal and interest. Principal is the dollar amount of the loan. Commonly, we call it the amount of money remaining to be paid off on a promissory note, or the loan balance. Interest is the rent charged for the use of the money. Remember that a straight note will charge a higher rate of interest than a fully amortized installment note. A fully amortized installment note is a promissory note where both the principal and the interest are paid in equal installments until the debt is paid in full. Then we come across the installment note with a balloon payment. This is a partially amortized note. It's a promissory note with periodic payments of principal and interest, and then a large payment at the end of the installment period, also known as the maturity date or due date. Understand that with equal monthly payments, the monthly payment amount, including principal and interest, is constant, but as the loan is paid off, the amount of the payment attributed to interest decreases, and the amount attributed to the principal increases. So at the beginning of a loan, most of your payment will go towards the interest. At the end of the loan, most of your payment will apply to the principal. Also for your exam, remember that we use an amortization table to come up with the monthly payment. Also remember that a promissory note is a negotiable instrument. A negotiable instrument is any financial document that can easily be passed from one person to another if it meets certain legal requirements. The most common example of a negotiable instrument is a personal check. Also note, holder in due course is someone who has taken a negotiable instrument from another in good faith, without knowledge of defect. Now here are some important clauses involved with financial instruments. First, we have the acceleration clause. This states that upon the occurrence of a specific event, the lender has the right to demand immediate payment of the entire note. Now the main purpose of an acceleration clause is to make the entire balance of the loan due and payable at once. There's also the alienation clause. This is a form of the acceleration clause stating that the entire loan becomes due and payable when the property is either sold, assigned, transferred, or otherwise alienated. Alienate or alienation is one of those terms you'll find in the glossary. This means transferring of property to another, the transfer of property and possessions of land or other things from one person to another. In the current real estate market, you won't find too many loans that will allow for an assumption. An assumption is when a buyer assumes a loan on a property that's already encumbered. That person has the responsibility with the lender's consent for full payment of the loan. Basically, the name on the loan is changed to that of the buyer. In order to assume an existing loan, the promissory note cannot include an alienation clause. A seller is protected from liability for payments on an existing loan when the buyer assumes the trust deed. And at some point in your real estate career, you'll run across the concept of a subordination clause. A subordination clause gives the borrower the ability to obtain additional loans on the property that have a higher priority. And with the creative financing of the current real estate market, you also hear a lot about prepayment penalties. This is a charge to the borrower for paying off all or part of a loan balance before the due date, or before the payment penalty period expires. Most lenders use a prepayment penalty clause on fixed-rate loans, but they're rarely employed with the adjustable rate loans. Also notice that the prepayment penalty is only enforceable during the first 5 years of a home loan. This applies to 1 to 4 unit homes. Impound accounts are reserves. They are money collected in advance from borrowers to assure the payment of reoccurring costs such as property tax and homeowners insurance are paid. Now we're going to move on to security devices. These are financial instruments. Now, security device is a written document that pledge real property as security for a promissory note. Now, the 3 financial instruments used in California are mortgages, trust deeds, and land contracts. Now, the mortgage contract is a financial instrument in the form of a lien that secures a property for payment of a promissory note. In California, you'll find when financing a piece of property, you'll be using a trust deed. Mortgage contracts are not commonly used in California. Now you may be wondering why. The answer lies in the procedures it takes to remedy a default. In a mortgage, the only remedy for the lender is a judicial court foreclosure, unless the mortgage contains a power of sale clause. Now, although the actual mortgage foreclosure takes a short period of time, the redemption period is very long. It's 1 year. Now, in a deed of trust, the entire process, including any redemption or sale, requires a short period of time, approximately 4 months. Now, you can see why a lender would choose a trust deed over a mortgage contract. Now, I brought up the term redemption period. Well, this is the legally accepted time period for buying back one's own property after a judicial sale. Now, during that 1 year redemption period, the right of possession remains with the borrower. Now, the way the power of sale clause works, this allows the mortgagee, this is the lender, to sell the property without a court proceeding. This is much like a trustee's sale. This is if the mortgager or borrower is in default. Now, if there is no power of sale clause, the court action is required for a foreclosure. So let's look at the more popular trust deeds. Now, trust deeds are personal property. A trust deed needs a note for security, but a note does not need a trust deed. A trust deed is not a negotiable instrument. The note is negotiable. And remember, if the conditions of a note and trust deed are in conflict, the note prevails. Now, trust deeds are security devices that make real property collateral for the promissory note. You'll also hear the term deed of trust, which is basically the same thing. Now, the parties involved in a deed of trust is the trustor, trustee, and beneficiary. The trustor is that party who's borrowing the money. The trustor signs the promissory note and trust deed. This is the person who owes the debt. The beneficiary is the lender, who is lending the money for the purchase of real property. The beneficiary holds the trust note and the trust deed. A way to remember this is that the beneficiary benefits from the loan. They're earning the interest. Well, then who's the trustee? Well, this is a third disinterested party that holds what's called the bare naked title to the property. This is normally the title insurance company. They hold the responsibility of having to sell the property for the beneficiary should the trustor go into default. So what is bare naked title? It's basically legal title. What the borrower or trustor has is what's called equitable title. While the borrower is repaying the trust deed and note, that person may enjoy all customary rights of the title and possession. Remember, in a trust deed, a power of sale clause is always included and is given from the borrower to the lender. Now, when a loan is paid in full, what the borrower will receive is full reconveyance. This provides the proof that the promissory note and the accompanying trust deed have been paid in full. A full reconveyance must be recorded on the county records and given public notice that it has been paid. At this point, the borrower now holds equitable title and full legal title. Now let's look at defaults and foreclosures of a trust deed. Now, the lender has the legal right to receive the trust deed payments on time, and by law the lender can start default action after the 10 to 15 day grace period. Now, the grace period is a set number of days that the lender will allow payment to be late without any penalty. If a note and trust deed does not state a grace period, the law states that it must be more than 10 days. Now, when the trustee, this is the title company, is notified by the lender, this is the beneficiary, of the trustor's non-payment, the trustee records a notice of default. Now, within 10 days after the recording, all parties involved will receive this notice. In addition, the notice of default must be published in a newspaper of general circulation once a week for 3 weeks. Now, the borrower has the protection of a reinstatement period, which is normally 3 months. This is the time in which the borrower may pay all the past due payments. This reinstatement period runs until 5 days before the date of sale. The next step after the notice of default is the notice of sale. Now, the notice of sale is a recorded notice by the trustee stating the time, place, property description, and type of sale. This notice must be, just like the notice of default, published in a newspaper of general circulation once a week, not more than 7 days apart. A copy of this notice must also be posted on the property and in a public place, such as the City Hall. Now, most title insurance companies also post a copy if they are acting as the trustee. We move on to the trustee sale, or foreclosure sale. A trustee sale is only for the real property backing up the trust deed. The sale is held out of court at the time and place stated on the notice of sale. Now, the only consolation for the borrower is that any money more than the amount owed is reimbursed to them. The new owner is entitled to immediate possession. Another remedy if the borrower is in default is the deed in lieu of foreclosure. Now this is a deed given by the owner to the lender to prevent the lender from bringing a foreclosure proceeding. Now this is up to the lender to reject or accept such an offer. One more thing to remember is that most junior liens are eliminated by a foreclosure sale, and we'll talk about junior liens in a moment. The following liens are not eliminated: federal tax liens, state, county, and city taxes or assessments, and mechanics liens for work begun before the trust deed was recorded. Well, to finish up this topic, what would happen if the sale of the home does not bring in enough money to pay off the debts? Well, the lender would file a deficiency judgment to collect the difference. Okay, I'm glad to be done with that topic. Let's move on to second trust deeds, or junior liens.